Maybe that's a good way to start. So if you just pop where you're joining in from in the chat box. Thanks, Sienna. You're also in Brizzy. Uh, and Rose is in Brisbane. Very cool. Just while you're doing that, also another thing that I love with these workshops is if you pop your cameras on and just make it feel like a bit of a workshop versus just a one-way me talking to a screen. Feels a bit better that way. Thanks, Calvin. Awesome to see you in Redcliffe. That's pretty close to where I'm calling in from, actually, from home at Bridgewood Downs. Hey, Sienna, Tom, a couple of people from Melbourne, Tony. Sweet. There you go. Cool. Well, yeah. So in terms of the housekeeping for today, we've got just under 90 minutes remaining, and yeah, in terms of the way I present, so you can see that there's some slides to the right of me as you look at the screen. If you pop me full screen, sometimes there's a bit of text that is a bit small, but full screen should make it appear nice and easy to read. And then the other one is have the chat box handy, but because we are in a Zoom meeting, not a Zoom webinar, you can actually take yourself off mute, and we can even have a, whoa, Apple's talking to me. Yeah, you can take yourself off mute, and we can literally have a conversation just as if we are in the same room together. So, yeah, that is the sort of the setup with Q&A today. Just a bit of an introduction for those who haven't joined me on a webinar or workshop before. So we run an accounting firm in the Fortitude Valley called Inspire, and we work with small businesses all around Australia. In terms of our focus, one of the big ones is saving our clients tax, and we track that. So we track that for second opinions that we do, but also each year in tax planning, we track that for clients as well. And our tally since we started counting in 2015 is up to 37 million. Now with tax planning coming up over the next few months, we expect that's probably going to crack 40 mil. Usually we get at least a few mil every financial year, which is exciting to tick over that tally. And a bit of an introduction to me. Yeah, my name is Ben Walker. I started Inspire when I was 23 years old. I'm an award-winning chartered accountant with over 17 years accounting experience. And I have also written and published two books, Wealth for Life, which is all about how business owners can focus on building their family's wealth, but also It's All Sorted, which is very much focused on what we're talking about today, which is, on how the tax works for business owners, how structuring works, but also the tax saving strategies as well. So it goes very heavy into that. Let me just hit that button. Cool. Hey, Nick. Cool to see you join. Very cool. Alrighty. But yeah, that's a bit of an intro to me. Now, if you do want a copy of the book, here is the QR code to get that. If you are a client, just send me a note and I'll get you a discount code to give it for the cost of it, how much it costs to print. And they are expensive to print, actually, by the way, if you're confused by how much it still is because of the color behind it. So anyway, if you are a client, then just send me a note. Alrighty, so what we're going to cover today, sort of three key areas here. The first one is we're going to go through some business structuring first. Now, the reason we do that is because I think that gives some foundation knowledge to how structuring works in Australia. We're going to shift gears over to covering your assets. We're going to talk about asset protection. It's a topic that most business owners want to know a little bit about or enough about to know where the dangers lie and what you can do about it. And then we're going to sort of wrap up with a bit of rapid fire tax saving strategies. There will also be a 5-minute break too for coffees, waters, etc. Yeah, and that's usually roughly about halfway through. So again, we're going to run through some structuring basics. Now, the first thing we're going to go through is the individual tax rates. Now, this is adult individuals and residents of Australia. If you're a child or a non-resident, things are slightly different. Now, that's non-resident for tax purposes. Yeah, keep that in mind. It's easier to be a tax resident than it is to be an actual resident. But anyway, so we've got this first line here, that tax-free threshold, this one's called. Now, it does say 18,000 19,200, but it works out to be about 20 grand or so when you factor in low income tax offsets and that sort of thing. And sorry, just a heads up, these tax rates have changed over the last few years. They tweak, with different governments, different budgets who change this. And what we've seen is the tax rates go down slightly in a couple of these brackets, but also particularly this one here, the 135K mark, that was previously 120K. And I feel like that's a bit to do with inflation where, the 120K was a bracket for as long as I've been in accounting and moved it up to 135 now. So anyway, so the next bracket we're looking at is 18 cents in the dollar. That includes the 2% Medicare levy as well. And we've got about 20K to about 45,000 in income. Once we hit 45 up to 130, we're looking at 32 cents in the dollar. And again, for most business owners, that's roughly where we're looking to sit. And if we think of what we call a magic number of taxable income, where we're looking to distribute income across a family group, this 135K mark is usually where we want to sort of stop before we might consider, other things like entities or other people to distribute that across. And also, thank you, Tay. So Tay has posted a link in the chat box for a workbook. Now, the workbook follows along similar to my slides. If you want to sort of make notes as you go, that's something that is up to you to do. The link is in the chat box. Next bracket here is the 135K to 190K. You're looking at almost 40 cents in the dollar. We're getting up there now. There's usually better places for it to end up if you have the ability to do so. And then over 190K, you are the recipient of almost half your income over that point going to the tax man. Now, if you do have HECS or help debts, that will send these tax rates higher again. So that excludes that. So again, this is purely just income tax plus Medicare levy is what we've got on the screen here. So yeah, the whole idea of the marginal tax rates is the more you earn, the higher your rate. Now, that doesn't necessarily apply to your whole income. So let's say you're getting paid 200 grand. It's only the amount over 190 that will be taxed at 47%. You'll still get, for instance, the first 20K or so tax-free. Alrighty. Next section here, we're looking at companies and trusts. So companies where they run a business and their revenue is less than $50 million, you're looking at a tax rate of 25 cents. Now, that's actually quite decent where you look at the marginal tax rates back here, where, 25 cents is actually less than all three of these top rates here. That's been a great thing that was brought in what feels like about 5 or 6 years ago now, where the company tax rates for what they call small businesses, and under 50 mils, pretty generous there to be qualified as a small business. Under that limit, then we're good with that concessional company tax rate. If the business turns over more than 50 mil or it's predominantly investment income and there is percentages you've got to test against, then you're looking at 30% tax on that, which again is still okay compared to some of those higher individual tax rates. Now, if we compare that to trusts, trusts, it says 0% here. Trusts don't pay tax themselves. They actually give it to other people or entities in the family group who then end up paying the tax on the income that they get allocated. So people who receive money from trusts are called beneficiaries of the trust. We'll go through some examples of that towards the end of the presentation. Workshop. Now, this 47% tax rate, again, we ideally, there's not many situations where we would want that for a client, but if a trust does not distribute its income, then that is the tax rate a trust pays. It's basically essentially a penalty rate for not allocating it to someone or something. And then we go down to SMSFs. So self-managed super funds, or really we can refer to superannuation generally. We've got two different tax rates. We've got 0% when the person is in pension mode, that's the language that we use, when they're drawing their money later in life, when they've hit the required age to draw a pension, and they've hit conditions of release. And then accumulation is throughout their lifetime. When you're accumulating your balance over your life, you'll pay 15% on the earnings in the SMSF. So that is an overview of some tax rates. Again, for the people who might have joined a bit later, in terms of Q&A, please feel free to pop a message in the chat box. I've got that open on my screen over here. But also, if you do want to have a chat or ask a question verbally, just pop yourself off mute, and yeah, we can have a chat. Alrighty. Now, in terms of like comparing the business structures themselves, broadly, we've got three types of business structures: sole trader, or it's you as an individual. Now, I'll also put partnerships in this box too. So partnerships of two people, not when you have a business partner, because when you have a business partner, we want you to set up through companies or trusts. Anyway, so the language I use for partnerships here is literally two individuals. It's a big something we want to avoid. It's like worse than being a sole trader for a couple of reasons. But yeah, individuals, we saw that the tax rate goes up to 47%, even more if you've got HEX or HELP. Asset protection, you do not get asset protection with being a sole trader or in a partnership of individuals. If the business is sued, they're literally suing you as a person, and then any personal assets that you own may be required to pay out if you are unsuccessful in defending. And then you've also got tax planning here. So yeah, running as a sole trader, we're really limited with options when it comes to tax planning. Things like the company tax rate of 25%. We just can't get income from a sole trader over to a company to do something like that, for instance. So yeah, we're pretty limited from that perspective. Now, if we compare that to a company, so we draw companies as triangles at Inspire. There's two different tax rates I mentioned earlier, 25 or 30%. Now, it does get a tick for asset protection because, and I suggest here that as long as it's set up correctly, I've seen some poorly set up structures over the years. And then when it comes to tax planning, we give that one a tick. Again, it's got to be set up properly to get the maximum benefits of asset protection and tax planning. And what do I mean by set up properly? I mean things like who's the directors, making sure that's thought through, and also the shareholders of the company, making sure that that's appropriate within the family group, because there is options for that, and how that is structured or owned or who's the director does mean differences when it comes to asset protection and tax planning. If we go over to trusts, so yes, I've got 0%. If you structure as a trust, that's because, again, the trust gives it to other people in the family group, and so or entities. So, for instance, if it gave it to an individual, you'd pay tax at the marginal rates. Or if a business trust actually gives it to what we call a bucket company, then you'll actually get that concessional tax rate of 25%, assuming you meet certain conditions. But it's pretty easy to do so if the trust runs a business. In terms of asset protection, trusts get a tick as well. And also from a tax planning perspective, having a trust in there also gets a tick. Now, with companies and trusts, I know I'm sort of talking about one or the other, but where we've got when we're structuring a business for a family group, often we'll actually have a combination of both of these things. So we will rarely, in fact, I don't think there's instances where we would have a company without a trust, and vice versa. We wouldn't set up a trust without a company in there somewhere. So, and usually if you've got a trading trust, it'll be the company acting as the trustee, or if you've got a trading company, you'll have the trust that owns the shares as the shareholder. So I know if this is sort of the first time you've listened to some of these concepts, it might be quite confusing, but again, usually we have some people who have both, and they might not be super clear if they need it or how it works. So that's why I sort of flagged that actually, I'm talking about them on their own, but you do need the combination to get the maximum benefit out of these things. Okay. So we've talked about structures. Now we are going to shift gears into asset protection and how that works. Now, I often refer to asset protection as a continuum of risk. And I've noticed that some clients are really risk adverse and they want to, go out of their way to make sure that they set up structures really well with asset protection in mind. I've also seen clients who don't care. What we want is ideally a bit of a balance between the two, because often we don't put much importance on asset protection unless we've built some assets to protect, but also until we might need asset protection. And often, if we're at the point where we need asset protection, it might be too late to go and implement some of these things. So, often it's just getting things right at the start or when you set up the business. And if you've already got things in place, there's options to potentially add that asset protection in. But again, earlier is better with this stuff. Yeah. So in terms of on the screen right now, we've got high risk and we've got the picture of the person there. I referred to earlier as sole traders being high risk when it comes to asset protection, or basically affording no asset protection because you are trading in your own name. Now, if we move along the continuum, we've got companies or trusts. So remember where I spoke about companies are triangles, trusts are squares or rectangles at Inspire. So if you've got a company or trust in there, you're moving somewhat along that continuum. And there are, and sorry, before I go into that one, there is a wall between the two over here. And that is what I call, well, I call it, it is called the ASIC's corporate veil. So what it means is basically the director's assets are separate to that of the company's, or in the case of a trust with a corporate trustee, the trust's assets held on behalf with the company. So there is a line in between the two, but if you think of it like a brick wall, brick walls can still be knocked down, although often not ideal. Now, the things that can get through that protection is fraud, for instance. I don't really have too much of a response for that. If people are going to commit fraud, I don't feel like their personal assets should be protected. The next one here is director's guarantee, and this is a bit of a tricky one. So where director's guarantees usually sit is in lease agreements if you're renting a premises, or finance agreements if you're buying let's say a vehicle. But you even see it with supplier contractors, depending on who you work with, and the sort of suppliers that you work with. And what it basically says, if the entity can't pay the bill, like the company or the trust can't pay the bill, then we can come after the assets of basically ask the director to pay the bill. And if they don't, we can sue the director. So it sort of aims to get through that corporate veil. So again, they can be pretty sneakily popped into contracts without people knowing. But yeah, again, the common ones are leases, finance agreements, and supplier contracts. So, yep, that's that one. And the next one here is insolvent trading. So yeah, what insolvent trading basically is, or the definition is, where the entity can't pay its bills as and when they are due. Now, there is an obligation on directors to ensure their entities don't trade insolvent. And if that is broken, that is technically a way that people can come after personal assets. And again, like, even over the last 5 years, I'd suggest it's pretty rare to have many businesses that weren't at some point at risk of this. And even from time to time, generally in business, you have bad months, bad quarters. So this is something just to be mindful of with insolvent trading. And again, with this stuff, if you are at risk of insolvent trading, it's better to engage, accountants or insolvency practitioners as early as you can before the hole gets too deep and it's harder to dig out of. The next one here is superannuation, but I'll also pop in like GST and pay-as-you-go withholding. So there is risk for basically employee entitlements like super, pay-as-you-go withholding from their wages, but also GST, depending on if you lodged your BAS on time, there is a certain period after which you will be personally liable for your entity's BASs, even if they're lodged late. So again, it's important to keep lodgements on time and that sort of thing, and especially payments of superannuation. The other one with super is that late payment of super means it's not tax deductible, and that's a big eye opener. Even if it's a day late, it's pretty insane. So keep that in mind when you are planning out cash flow and making sure you make those superannuation contributions on time. All right, so those things are examples of things that can get through the corporate veil, and I guess essentially attack the personal assets of the director. So, what is the workaround to that? Well, to move further along the continuum here, the risk continuum, it's for the director of trading entities or anything with carrying business risk, the director themselves to be worth pretty much nothing. So, for instance, the director of trading entities, we don't recommend owns the family home. They don't own crypto portfolios or share portfolios and things like that. And yeah, so what we want to do is structure family assets or investments in either the spouse's name if they're not an at-risk person, or in trusts or other companies. So we just had a question pop up. Yeah, so just a question on the superannuation. If you pay it late, late payment of superannuation, this is the superannuation you owe employees, which is, so let's use an example. So we're in the March quarter of 2025. Any wages you pay for employees in the March quarter, the superannuation related to that is due by the 28th of April. If you pay that late, even by a day, then your superannuation payments are not tax deductible. And the legislation is worded, it's not when you make the payment, it's when it's actually received by the fund, which again, when we're using things like Xero or clearing houses that direct debit our bank and then puts it in the air and pays it to the super fund a few days later, you've got to be very careful that you don't go over the time limits there. So we recommend probably the latest you should be paying it is about the 20th of the month following the quarter, if that makes sense. So if it's owed on the 28th of April, pay that no later than the 20th for it to settle. Even if the direct debit fails, for instance, and you're late because of that, technically the super payments are not tax deductible. So yeah, I hope that helps, Tony. Alrighty. The next one here is the categories of risk to a business. Now, this is basically answering the question, why should we be worried about asset protection anyway? Well, there's many ways you can be sued in business, and these are categories of people who might sue you. The first one is clients. So this one I feel is a bigger risk for some industries than others. Particularly like medical industries or financial. Where you deal with people's money, that might increase your risk of clients suing you if you cause them a loss. But again, yeah, this is, I feel, heavier in some industries than others. But yeah, always a risk that you may be sued by something you do for a client. If we reverse that, people you pay money to, so suppliers, if you don't pay their bill, you have a disagreement with them in terms of what they've provided to you versus what you believe you should pay for, or even the ATO. We see the ATO if you're not lodging on time or paying your tax related to that. They can issue you wind ups or all sorts of stuff. They've got pretty intense powers, and so from an asset protection perspective, they can be a risk to us too. Here's a big one. Yeah, unfortunately in Australia, employment law is not written in favour of the employer. It might be a little bit too far in favour of the employee. But again, it's something we need to be mindful of. I was talking to a client who does sort of HR consulting. This is years ago now. I think she was saying that the Fair Work Act, per breach, you can be charged up to like 60 grand or something. It's probably more now. And yeah, it's just a nightmare. That'd send a fair few small businesses broke if that was the case. So yeah, that's another risk. Next one here is competition. Again, this is a bit of a wild card, this one, and maybe more so relating to if you infringe a competitor's intellectual property rights or something like that, they might get crabby and sue you. Yeah, this is probably a bit lower risk than the other three I mentioned. So again, that's why we need to be concerned. So yeah, this concept is sharing a little bit further about the director of the trading entities owns nothing, and the other spouse, if you do have a spouse in the picture, they end up owning or controlling the family assets. Now, how that works is the risk taker is the director of trading entities, or the director of trading trustee companies, if it's a trading trust. Ideally holds no personal assets, and the asset holder controls the assets and holding entities. So things like asset trusts or bucket companies, that's our language for what we refer to with these entities. 100% ownership of family assets, like potentially the home or cars. Now, yeah, this is, I mean, it's pretty normal for husband and wife to own, let's say, the family home 50-50. You know, we see it all the time. But again, when we learn these principles about asset protection and you run a business, ideally we don't want the director of the trading entity owning the half the house. Especially last few years, if you've owned that home throughout that point, you've probably got equity in there enough to become a target. And then other roles for the asset holder are the shareholders of entities, trustee for asset trusts, and the appointor for trusts as well, which is essentially the ultimate controller. Oh, well, we've breezed through that, the first couple of points. So I might just pause the timer. If anyone does have any questions, yeah, feel free to take yourself off mute and we can run through that. Although if anyone does not have questions, I will restart that timer and we will come back after a break.
What if both husband and wife are at risk, like doing business and stuff?
Yeah.
How do you, yeah.
Yeah, great question. So so we've had that example where both the husband and wife, is this running separate businesses?
Yeah. Mm-hmm.
Yeah, okay. So I've got to be careful how I answer this. So I'm not a lawyer, so not legal advice. But generally we want one person to be the director of both entities. But we've got to be careful because if they're just a director for the sake of director, you can be at risk for this thing called shadow directorships, where it essentially means that you're doing it to deceive and in effect someone else is the director. So yeah, you've got to be careful from that perspective. No, a director essentially needs to meet the obligations of the Corporations Act for that company, and essentially, like you want ideally one person to be able to run administratively, you know, hire and fire the team, that sort of stuff is what a director does. Now, where you've got situations where both are running the business and you sort of can't avoid, you know, they are literally like running them separately and you've got the risks of shadow directorship, then unfortunately you can't get around that, you know, essentially having to be a director of each. And then we can look to structure family assets in trusts, potentially getting, you know, other people of control to, you know, other family members to assist in that, to reduce risk. But again, it comes also back to the clients where they sit along that risk continuum as well.
Yeah. So it's best to have one person that take no risk and take all the director
ideally
roles.
Yeah, where possible. And again, there's always that shadow directorship if it's not legitimate. Yeah, that sort of stuff. So, you know, maybe your assessment in that case is who's got the riskier business, and that's who's the risk taker, and the asset person is the one that doesn't have as much risk. And again, with asset protection, you know, ideally you've got things in place such as terms and conditions with your clients. You've got insurances for you can get management insurance, which covers some instances with, the risks that employees have. There's things you can do to mitigate before structures. But again, we got, and sometimes we've got to make the best of the outcome. Like sometimes we've got clients who are single, they don't have a spouse. It's also very tricky using a parent with being the asset holder, because what if the parent passes away and you've got siblings?
Yeah.
Is it the asset of the parent, and is it shared between your brothers and sisters? All of that stuff makes it pretty tricky. So yeah, got to make
like playing chess there.
It is.
Yeah.
That's it.
Thank you.
Having a good lawyer if things get a bit heated.
Yep.
Very good. Alrighty. Tom's asked a question. Do you cover income splitting for sole traders? I sort of touched on that earlier, Tom, that as a sole trader, you can't really income split because the income is earned in the name of a sole trader. Income splitting is usually referred to sharing income between other family members. If you employ another family member and they work legitimate amount and they're paid market rate, there's no issues with that. But if you're looking to structure appropriately where you can income split without all that sort of drama, then considering companies and trusts to run your business from is the way to go. Okay. Another question. A question about the ownership of assets. Can you elaborate more about protecting assets in a trust? What situations is this typically involved in? Okay, so where we've got clients who want to start investing in shares or a crypto portfolio or buy a investment property, let's say, again, if you're the director, you're the risk taker, we don't want those things in your name. We want them in ideally a trust for asset protection and tax planning, because if you make income from these things or you make a capital gain, we can choose who in the family group receives the ultimate income from the trust. That's why we want them in let's say a trust or even a company in some instances. And then having them in a trust gives them some layer of protection. But then what's often looked at is who controls the trust. And if the only person who controls that trust is the risk taker, then and again, this is speaking hypothetically from a legal perspective, it can be seen that the person controls the trust anyway, and it's their assets, and potentially become exposed. So that's why we have the asset person take the control roles in let's say an asset trust, and then you've got that clear separation between the risk taker running the business and the family's assets. Yeah, so it's basically like if you use my situation, I've got no property in my own name. If I get sued, I don't even own Inspire the business. Like it's all held in trusts that have nothing to do with me. So I'm not a very tempting target if things get hairy. Cool. Sienna, did you have another question?
You might cover this later. What's the difference? I know there's a massive difference between having a trading company under a trust versus having a trading trust under a company. And when do you use which structure? What's the benefit and pros and cons?
Yeah. Great question. I'm just going to hide my slides for a sec. So I don't cover this in detail in the slide deck, but I can do it. Just give me a moment. Let's go again. So I'm just trying to get my iPad in. If this doesn't work, I will answer it first thing back from the break.
Okay, that's fine.
Okay.
I think people need a break anyway. Thank you.
Yeah. All right. So we'll go to a break and then I'll fix how this iPad's supposed to plug into my computer here, and
Yeah.
we'll run through why you would want each of those, or what the benefits are of a company versus a trust are.
Yeah. Cool.
All righty.
Thank you.
Very good. No worries.
Yes, hello.
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 Hi, is that Cheryl?
Yes. Hi.
Oh, hey, how you going?
Good. Is this a session on my own or is this with other people?
This is with other people. So this is the Safe Tax Workshop. Is that what you were expecting?
Yes, yes. I'm so sorry I'm running a bit late. I'm so sorry.
Yeah, that's okay.
All right.
Oh,
I'll just mute myself again.
yeah, all good. No worries. Okay. And Sienna, the good news is my iPad's working.
Yay.
Alrighty. Pause button on Van Halen. Alrighty. So cool. All right. So Sienna's question was, I was talking about running a business through a trust with a corporate trustee versus a company owned by a trust. So they're kind of our two go-tos. So we're going to run through the differences there. So I'll draw them first, and then we'll talk to them. So the first one on the left, I'll draw as a company, awful looking triangle. And now a company has Pty Ltd in the name, and How we draw the ownership is by that line there, and we've got a trust down here. So this is a company owned by a trust. Now, I'll do the other one, which is a trading trust. Now, how we draw that is basically having a trust like that with a company on the top. So the reason why we draw them together is because we refer to that as the company as trustee for the trust, and that's how, you obviously got your name of your company and trust in there, but that's how they're referred to as almost a unit together. Versus on the left-hand side, we've got the company which runs over here, owned 100%, or doesn't have to be 100, but owned by the trust. Now, with the trust down here, it also needs a trustee. Now, a trustee can be a person or a company. Often for asset protection, we want companies as trustees. Definitely for business trusts, and then preferred for asset trusts like this. But let's say you have an asset person. Sometimes if the client doesn't want to do a company trustee, we can set it up with an individual trustee. Again, I just don't prefer them as much. So that's how we would draw them from a structuring perspective. Now, the differences between the two is how you take money out and how profit builds up. So they're kind of the two key differences. Now, if we go to how you take money out, so we've got proprietary limited, a company at the top with a trust down the bottom. Now, there's essentially 3 ways to take money out of each entity. The first way to take money out of each is to pay a salary. But with a salary, you've got to take tax out as you go, even if it's to yourself. So pay as you go withholding, and you have to pay super. And like I said earlier, you got to pay it by the due date to be tax deductible, even if it's to yourself. Now, there's a long-standing myth that as a director you don't need to pay super. It's wrong. It's been wrong for a long time. So that's something you need to keep in mind. Now, if we look at a trust, it's the same method for the first way to take money out of each. So it's exactly the same. Now, you can't take a salary from, let's say, an investment only trust in most instances. So like a bucket company we refer to, or if a company or trust owns a property, the salary doesn't really work from that. But what I'm referring to here is businesses. Now, the second way to take money out of a company is through a loan, but there are issues with that, or rules regarding that, and we call that Division 7A. If you've structured with a company somehow, and you may have heard your accountant talk about company loans or Division 7A, we don't avoid them at all costs, but they need to be managed. Basically, it's almost like a credit card. You can loan it from a company, but you've got to pay it back, and you've got to pay interest if you don't meet certain requirements. So, that's the second way to take money out of a company. Now, the second way to take money out of a trust is also through a loan, but you don't have the Division 7A requirements unless the trust is lending money to a company. Sorry, lending money from a company. And we call loans from trust drawings usually. Now, the third way to take money out of a company is called a dividend. Generally, this is a payment of prior year profits, versus the third way to take money out of a trust is distributions. Now, to illustrate the difference between the two, and distributions are current year profit. How we normally describe the difference between the two is that a company is like a bucket and a trust is like a funnel. Now, when you pour water, or in my example here, profit into a bucket, it fills up. And then the taxman comes along and takes a chunk of that of tax. So you lose a bit. But the rest of it we refer to as retained off earnings, and you can pay dividends out of retained earnings after that fact. So if we compare that to a funnel, you pour water or profit into a funnel, it has to go out the bottom, and we pay that to people or entities in the family group, and then they pay the tax for it. So there's like one of the big differences. Now, again, if we apply that to this situation, if you've got a company and a trust in the left-hand side here, this one is in my pen. So this one here. Now, this entity can retain profits. And you may want to do that to retain working capital without having to allocate it to a beneficiary in the case where a funnel operates over here and you have to allocate it out. Now, again, I sort of feel like that's not much of a huge pro or con. But the other one is the big one for me with trading companies is that because you retain profits, yes, you pay a flat rate of 25% tax, let's say, you're still left with 75% of your profits that are at risk. If you're, if I draw a line or I circle the at-risk things with red boxes, you've got profits building up over years, and they may be exposed to the risks we talked about earlier. So yeah, that's one of the reasons why I don't prefer trading companies. But there is a way to limit that, and you regularly pay down dividends so that you don't build up masses of retained earnings. Whereas over in a trust, each year you literally allocate all your earnings to something else. So yeah, they're some of the key differences between the two. Hope that helped.
Yep. Thank you.
All righty. I'll go back to my slide deck. Yeah, so now we're going to shift gears to tax planning, and sort of just describe what tax planning is. So we do tax planning between March and June every single financial year for every single client that we look after. And what the process involves is estimating profit for the year for the family group, and then working out what the likely tax impact of that is. And then we work through strategies to reduce that if they're available to us. And then if there's anything to implement to make those strategies work, obviously there needs to be an action plan. And most of those things are required to be implemented before 30 June, which is the year that it, the tax planning relates to. So let's walk through a high level an example of that. So let's work out that the taxable profit of a family group might be 300 grand, and the average rate of tax, if nothing's necessarily done, is 25% tax. Therefore, you're looking at 75 grand in tax. If we go through strategies, apply them, our taxable profit might reduce as a result. So in this example, I've given a 50 grand drop in profit, and the average rate of tax, let's say we've distributed differently with the trust across different family members or other entities, the average rate of tax has also dropped as well as the profit itself. So we're going from a tax rate of 25% down to 22.5%. So the tax payable after those things is 56 grand. So the value of tax planning for that family group, that's what we refer to as the 19 grand tax savings. And that's how we've got our $37 million so far in tax savings across our clients since we began tracking. So yeah, there's an example, high level of the process, but it refers to going into client zero files, forecasting that to 30 June, usually a phone call or a discussion with clients throughout the preparation, and then meeting with each client to discuss the result and also what they want to do, because some clients may prefer some strategies over others. Let's say one of them might be investing in more equipment for a business. The timing of when you do that might change your outcome for tax purposes for this year versus next year. And some strategies require money as well to implement. For instance, if you want to max out your super contributions before 30 June, you need to put that money into super. So yeah, that's just some overall considerations around tax planning. and what that looks like. But the key is take action before 30 June, and that doesn't mean calling your accountant on the 29th of June. It's probably not going to end too well, or at least be the best planned. Again, it's the reason why we're literally starting to roll out our systems for tax planning right now, to start the ball rolling towards the end of this month. Alrighty, so we're going to go through our 10 biggest tax saving strategies, and yeah, one at a time. Now, actually, I won't even go there, because really the biggest tax saving strategy is getting your structure right. So all of these assume your structure allows for these things, but making sure you've got the combination of trusts and companies set up, and you got the right directors in place, the shareholders are spot on. That really makes the biggest difference to our ability to save tax. All these things will help, that I'll run through, but again, structure is the most important. The first one here is salaries paid to business owners. And we've seen instances where business owners are paid too much from their business to the point where their entity is going into losses. Now, what that means is they're paying tax personally, where they could, let's say, reduce the wages they're paying themselves, put the company or trust back into a break even or even a small profit, but they're actually saving personal tax in the process of that. I remember one of our awesome clients from back in like 2015, was making $100,000 loss, but paying each husband and wife each 100 grand. So, we were able to adjust that to paying themselves 50 grand each, and the company broke even. I think it was like 20 grand a year in tax that was saved as a result. So, yeah, it's important to not necessarily just set a salary for good, just keep checking in that it's appropriate. And again, the process of tax planning will catch something like that if it's too high or too low, because you're checking this stuff in the financial year it relates to. Next one here is working your family trust. Now, the rules around trusts have changed so much since I've been in accounting. Even over the last couple of years, the ATO have changed their minds or perspectives. If they were here and they were talking, they'd say, "No, we've just clarified what we mean." But really, they've changed. They've been clearer with us around rules and how they apply to spreading income between your family. What it means is that if you distribute to you or your spouse, that's pretty easy. That's fine. Distributing to kids under 18, you're limited to $416 in income per year, which is not a lot of tax savings. Usually that's 100, just over $100 maybe. So it's hardly worth the effort. But if you've got retired parents, let's say, that aren't receiving Centrelink, like an old age pension, because the moment you go and distribute to someone receiving that, the amount of paperwork you need to do is enormous, and they're probably going to lose the old age pension. So if they're self-funded retiree, they've got no other income in their own name, you could distribute, let's say, $20,000 from your trust to them, if your business structure allows for that. And they would pay not a cent of tax on that. So, assuming they're all in their tax-free threshold. So, and again, the rules that the ATO have clarified recently have been that if you do distribute to someone who's not literally you or your spouse, the money needs to go to their bank account, and we can't do, oh yeah, let's flick it back or buy us a holiday or pay the school fees. We can't do what they call reimbursement arrangements. So it's got to end up, the economic benefit has to end up with the person that you distribute from your trust to. So yeah, that's the bit where they've gone, oh no, those rules from the 70s, here's what we mean by that, which, previously our recommendation was to pay the money to the person. We felt that the ATO we're coming for that sort of stuff where it's just on paper the person receiving the income rather than actual cash flowing through. But they've really clarified their position on that now. So again, yeah, if clients want to distribute to parents or brothers and sisters, outside the immediate family unit, then we've got to be careful with making sure money flows as well. Okay, cash up your super fund. Yeah, so with this one, again, usually clients have different perspectives on this. The younger they are, or if they're not pro super, obviously people care less about this. But if we've got clients in their 50s or especially their 60s, super contributions make a lot of sense from a tax planning perspective. In terms of contributions, there's two types. There's contributions as a tax deduction, and there's non-tax deductible contributions. Now, your tax deductible contributions, the limit is $30,000 per year per adult, and non-tax deductible or non-concessional, I think the limit's gone to 110,000 per year. Just 120, sorry, 120,000 for non-tax deductible contributions. So what we might want to consider is let's say you've got some free cash flow, you've got a big tax bill coming and you feel okay about putting that money into super, doing so before 30 June might save you 39% tax, 47% tax outside of super, but you will pay 15 cents in the dollar when it goes in the fund, or the super fund will pay that out of the contribution. So keep that in mind, that there's a net benefit still in most cases of putting money into super. There is also rules around catching up on unused tax deductible super contributions. So that's also another one that you can roll forward your limit for up to 5 years. So let's say you don't use the current year's 30 grand, you put nothing in. We can roll it over and put 60 grand in next year, 90 the year after, and so on. So what that's handy for is, let's say you're building your business, you don't have much spare cash flow over let's say the next few years, but you have a really big year or a big win, big inheritance, big capital gain from selling a property, and you want to manage your tax bill, boom, you've got that super contribution to be considered that might save you a bit of tax. It all has to be done in the financial year. You want to claim it as well. Also, the other catch with personal super contributions, so this is not out of your employer contributions. With personal contributions, you need to lodge a notice of intent to claim a deduction with your super fund. That's caught people out, where if you don't do that, technically you can't claim the deduction. And we've had instances where the super fund, if it's given to them late, they won't go and amend their own records, and it's a pain. So if you want to do that, notice of intent to claim, or make sure how you do your contributions are 100% correct. The other one is bringing forward or prepaying expenses. So small businesses can deduct expenses or prepayments of up to 12 months in advance. So again, this is pending cash flow, and this one is really just the timing of when you get the tax deduction as well. So if you prepay it, you get it this year. If you pay it next financial year, you'll still get the deduction next financial year. But again, keep in mind the time value of money as well. So, savings now is worth more than savings later. So, what we see here is some clients want to prepay rent, and even better, let's say you own your commercial premises in a self-managed super fund, you can prepay up to 12 months of rent. Literally, the transaction looks like money from your business going into your SMSF as rent expense or income for the fund. We also see, let's say you've got travel coming up over the next 6 to 12 months and you know about it. You can go and book your airfares, book your hotels and pay for them. We've got clients who prepay their accounting fees for 12 months, fill the stationery cupboard if you know it's coming. So there's some ideas to, again, bring forward expenses or prepay them the coming 12 months. Another one here is not paying tax on money you haven't received. So this tax saving strategy comes around what they call the receipts-based method of recognizing your income, and receipts being when it's received versus when the invoice is raised. Now, an easier way to explain the difference is cash versus accruals. Accruals is when the invoice is raised. Cash is when it's paid. Now, the guidance of who is eligible for this is quite grey, unfortunately, but it applies to service businesses more than people who sell goods. And the whole, like, let's say you run a small drafting business, you draw house plans for a living, and you've got a couple of team members, your turnover is $500,000, and let's say you're owed $100,000 of invoices at 30 June. If you elect for the receipts-based method, we can actually adjust them to be adjust the income to be taxable when it's received. So basically pushing that 100 grand of debtors into the next financial year, assuming you collect them in the next financial year. Hopefully you do. Yeah. So again, service-based businesses, and yeah, usually no more than six figures. So under $1 million is when we normally apply that. The ATO have what they call a tax ruling to guide you on who is eligible or not, or at least the factors they consider. So again, it's quite a grey area, but something worth exploring if it's pretty obvious in your instance. Next one here is writing off bad debts. So this is another one that a lot of business owners probably don't know the depth of. So if you've got people who owe you money in your zero file, let's say they're showing as debtors or accounts receivable at 30 June, you've got to write them off before 30 June to be able to claim them in that financial year. So ordinarily towards the end of June, I would pop a space in your calendar to review bad debts and literally write them off. Now, if this is not meant to be silly, but if they end up paying you a few months later, obviously you need to reactivate that invoice and pay tax on it. It's not meant to be silly, but yeah, if it's September and your accountant's preparing the tax returns and you're like, oh, hang on, that 20 grand that's owed there isn't going to get paid. If you haven't gone through the steps of like literally writing it off, and the best way to do that is not voiding it, but writing it off to bad debts in your zero file, then it's not technically tax deductible in the early year. Yeah. So, and what would constitute writing one off is if it's unlikely to ever receive the money, you've made attempts to recover it, that obviously haven't gone well. So, yeah, that's another one to consider. Motor vehicle expenses. So this one here is there's sort of two main ways to claim motor vehicle expenses: the cents per kilometre rate, where you've got to substantiate some sort of method of working out how many kilometres you're claiming. You are limited to 5,000 kilometres a year and it's a cents, obviously a cents per kilometre. I can't remember the cents rate. I think it's up 80 or 90 something cents, around about that. So it's not a very big deduction, especially if you're using your motor vehicle a lot for work. You also can't claim depreciation under the cents per kilometre method. Apparently the cents per kilometre takes into account a portion of fuel, rego, insurance, etc. So you can't actually claim anything outside of that. So more times than not, keeping a logbook, which is your other way of claiming car deductions, produces a much larger tax deduction, again, if it's primarily for business use. Under that logbook method, we can claim depreciation, a percentage of fuel, percent of GST on all those expenses, and that sort of thing. So yeah, it usually means thousands of dollars difference. Now your logbook broadly needs to go for 12 weeks of the financial year, and if your nature of driving doesn't change, you're okay to keep that logbook for up to 5 years. That's how the rules are written. So yeah, do it once every 5 financial years, assuming your driving habits don't change materially. Okay, so that's motor vehicle expenses. There is also a fringe benefits tax exemption on EVs. I'm not so much a fan of battery cars, but I know some people are. Yeah, FBT takes into account the private use or the private portion of a vehicle's use. There is an exemption for certain EVs. So I think they've got to be under the luxury car tax limit. Yeah. So, but if that interests you, then yeah, please reach out to your accountant to work out how you might just checking the vehicle is eligible that you're looking at, and making sure you buy it in the right entity, all that sort of stuff. And then I think this is the last one, the amazing power of bucket companies. So I'm actually going to draw this one. Here's my scribble. So let's say we've got a trading trust. And we go through the process of tax planning. And let's say you've got $500,000 of profit in a year. I will draw my family. I've got 3 girls and a boy and my wife. And then let's put the big bucket company over here. So here's essentially like my version of a part of my tax planning, which is how do I distribute my trust income across my family. So we learned earlier that 135K was the magic number for taxable income, because that's when the tax rate goes from, my goodness, all these rates in my head. That's when the tax rate goes from 32% to 39%. But because I run an accounting firm, it's called a professional services firm. I'm bound by additional requirements. And one of those requirements is to pay myself a market rate salary. So that's ballpark 180K of taxable income ending up in my name first before I do anything else. So some of you will have that same obligation. And again, there's certain industries or certain ways of how people produce income which might limit your ability to do what I'm showing you. So for me, if I ran a pool shop that earned $500,000, I can do almost whatever I want. Because I run a professional services firm, this is additional requirements for me. So yeah, I'd say 180K to my own name. And then because my wife Stevie doesn't have that same obligation to receive a salary, we can take her to that magic number of 135K. The 4 kids, they're all under 18. So 4 times 416 is what they'll get. For ease, I'll call it $1,600. And if we do the maths on that, make it easy on myself. So we started with $500,000, distributed 180 to me, 135 to Stevie, and 1,600 to the kids. So we're left with 183,400. Now let's assume we've already maxed our super contributions before the 500K profit. Now I could give it to me, but I'd be paying 47% on most of that. I could give it to Stevie, who'll pay 39% on some, and then 47% on the rest. If I gave it to the kids, they'd be paying 47% on everything. But if I gave it to a bucket company, I'd pay tax at 25%. So 183,400 ending up in the bucket company. So that's how we would tax plan from a how do we manage the trust distributions where there's no other available structures or entities or people who might be able to take some distributions. But let's say I had a parent who I wanted to help out, support, give them 20 grand a year in essentially like money to use for putting food on the table or whatever. I could do that out of that distribution as well, as long as I paid the cash to them. So yeah, that is the process of the benefit of a bucket company. And just to quantify that, so 183K going over to the bucket instead of me. So if it was me, it's 47%. If it's the bucket company, it's 25%. So you've got a tax savings of 22% net. And if we times that by 183,400, the bucket company has just saved you 40,348 in tax versus ballpark going to me. So it's fairly decent. Alrighty, so that's the sort of share there. I'm seeing a few questions come through, and I've got that slide up. Okay, so do miners need a TFN and lodge a tax return if they did receive 416 Whoa, am I frozen?
Yeah.
Okay. All right. I just got to reset my video program. Just give me a moment. Yeah, do miners need to have a TFN? No, not for the 416. There's no requirement to lodge that. You can, but I wouldn't worry about it. Interesting. Sorry, everyone. I'm having some dramas with my video. Let me. That's awful. I've got a backup webcam. There we go. Not as good quality, but anyway, it's something. So yeah, don't need a TFN or to lodge a tax return. Tony's asked, are you able to send some of the profit to a company or entity overseas to avoid paying tax in Australia? So Tony, there's rules regarding that, such as non-resident withholding tax, and yeah, you I think that's a question you'd need to ask very contextually and get some advice around. But it's not often something we see. Peter, how do you get money out of the bucket company though? Great question, Peter. So just like I mentioned about the requirement to pay to, let's say, a grandparent, if we're bringing them into the picture, they're with a bucket company. You've got to pay the trust distribution to the company. So often what we want to do is ensure that you and your spouse, for instance, get enough money to put food on the table and pay your cost of living, and that the money that gets paid to the bucket company, you can use to invest, for instance. So you can actually invest in the name of a bucket company. If you want to get that out, you can pay dividends, you can loan, but you've got the Division 7A management that comes with that. But yeah, that's to answer your question there, Peter. Cool. Alrighty. Well, I'm just trying to get my camera started again. I've got a couple more slides, which isn't going to work the best. But let's just do it anyway. Cool. So can you see a slide with look under the hood on it?
Yep.
Wonderful. Cool. Alrighty. Piecing it together here. All right. So I do want to share that we do a process called a look under the hood, where we give you a second opinion on basically what your accountant has prepared in their most recent financial year for your tax returns. It includes a meeting with you to discuss what we found, any questions that we've got, and obviously any questions that you have of how we've got there. And often that the result of that, we see thousands of dollars in potentially missed tax savings throughout that process. And we do charge for that. It's $750 plus GST. And yeah, we can run through questions that you've got on how your structure works if you haven't got your head around that, or any other questions that you've got about your specific tax outcome. So if you do want to look into that, look under the hood, then feel free to book in for an initial chat with one of our team, and we can just check that we're able to help. And then I did want to just touch on the way that we work with our clients here at Inspire. So we've got a tax and accounting subscription called It's All Sorted, and we sort of cover three areas for our clients with that. The first one is all the compliance that's required from the ATO and ASIC. So we do the tax returns in that, the ASIC annual statement, BASs and IASs, and checking and forwarding ATO letters and phones, etc. Moving on to the next bit. So the compliance is pretty standard, but the proactive meetings is things like goal setting, tax planning, which we're coming into right now, and an annual general meeting to discuss the year-end tax. And then from a support perspective, we've got a help desk, a dedicated accounting team that's assigned to you. your structure documented. So things like how I drew companies and trusts here, you'd have a copy of that, which you can use to talk to brokers, have conversations with lawyers if you need to, or even just understand it yourself. Online training, like you've got at the moment, like we're going through. There's also collaboration with other clients through our Facebook group and events that we hold from time to time. We've got an activation session when you come on board, and also My Prosperity, which is an app that we license on behalf of clients to help them track their family's wealth. And then the last one there is audit insurance. So previously there was a company that offered audit insurance to our clients, but and that was an opt-in process. But the last couple of years we've had this. Basically, we pay the policy on behalf of all our clients, and all our clients are covered. There's a certain amount of accounting and legal fees that's covered in the case of an audit from the ATO. Alrighty, so I've got time for a little bit more Q&A, and again, just a reminder that if you do want to have a chat with one of our team, booking in for a strategy call or initial chat with our team is the next step, and Rose has popped that in the chat box, the link for that. But apart from that, that brings my structured content to an end, and I'm glad that the video setup held it together for most of the session this morning. Wow, that camera's bad. I look like a ghost. Here for any Q&A if anyone's got some questions. Oh, before I reset my PC.
Is there like a annual income threshold before signing up the It's All Sorted package, or any small business can use that package?
Let me answer that question. So we do have a. Sorry, I just had something close on my screen. So usually a great fit for us is generally about $500,000 turnover to about 5 million. That's where most of our clients sit. We do have clients a little bit less than that if they've got a view to build into the sort of higher revenue. The reason why we do that is because we find that if we don't have that revenue or potential profit as a result, it's hard for us to add value through structuring and tax planning, let's say. So it's not necessarily intended for sole traders who are always going to be sole traders, we're really good fits for people who are in that revenue range, or you're going to grow quite quickly into that one.
Cool, thanks.
No worries. Alrighty, Tony. Cool. So Tony's asked, bringing everything up to date, can we get a health check? Yes, you can. So Tony, what I'd recommend if your accountant's currently finishing the bringing up to date, the look under the hood is perfect before you sign those returns and get them lodged, because if there's any things we pick up that could easily just be adjusted, and we had one the other week that was just a simple checkbox that would have saved the client 18 grand. If we pick something up like that, then you can do that before it's lodged. Otherwise, an amendment has to be prepared. So, Tony, the trigger for that would be once the accountant prepares all the catch-up stuff, but before you lodge it. That's the perfect time to reach out for the look under the hood. Thanks, Tony. And thanks, Tom. Appreciate that. Yeah, I hope that has been insightful. Very good. All right, thanks, Nick. Cheers. All right. Well, maybe we'll. Thanks, Peter. Sienna. We might wrap up there, and I can go and work out what has happened with my camera gear. All right. I'll see you later, everyone. Thanks, Julie. Thanks, Calvin.
Thank you. See you.
See ya.
Thank you. Bye.
Thanks, Josh.